with a lot of the Trump rhetoric on having Powell try to convince Powell to lower rates, right? So that kind of fits in with what you're explaining here is the secular inflation. If you have rising rates at the same time, you're looking at that 2021 to 23 spike, right? But it sounds like if you can counterbalance that with the right magnitudes between the two different impulses, maybe that's something you can actually maintain or not have seize up liquidity in markets. Do I have that kind of correct?
Yeah. So the reason I think we do eventually, like we're going to get these rate cuts, these next 75 to 100 bips of cuts, they're coming. They have to move them into the future to wait and see how price levels react, how unemployment reacts, and how the financial system stability reacts to this 180. I guess it wasn't a 180 because we'd already started the tariffs, in Trump administration number one. But we need to see how the system is going to react to not a 180, but a stepping on the gas of policy. So
Right.
what you're looking for here from a central banker standpoint is we want to make sure, all right, there is going to be inflationary pressure. Like price levels should rise from these from these tariffs. We need to know by how much, and we also need to know what's going to happen on unemployment because anybody who tells you, hey, this is Pollyanna, this is going to be Holly Smoot, Great Depression, etc., or anybody who tells you this is going to be, massively inflationary, hyperinflation, we're going to be Zimbabwe. Someone will be right? But at this
Right.
point, like from a market, we don't know which way this is going to break. Like if you think about it, so how strongly is the consumer going to hold up? Which is, really amounts to are the boomer retiree waves going to keep spending, right? And if you're going out and you're buying, like there will be some pullback, right? If some of these products, like if you look at everything the U.S. imports, like the biggest chunk is like consumer electronics. U.S. doesn't make its own iPads. So you've seen these exemptions given out to specific categories where there is no substitute good available that the U.S. can produce right now. Remember, like 2018 or whatever, there was a big headline push for, hey, Trump tried to get Foxconn to make, Apple products in Wisconsin, and it's just not going to happen. So like Android, iOS devices, all of that, like it's going to be hard for the U.S. to produce those, like like we cannot replicate those supply chains very easily. But there are certain products that you can, easily swap out between a Asian produced economic good or a European produced good and an American good. We can think of several HVAC systems, whatever, like laundry machines, dishwashers. And if you're out in the market buying one of those goods where the substitution effect or the substitutability of a good is there for the American production, then what the tariff does is it price is price, right? You're gonna be as a supplier, you are into a market, you're dependent on what the consumer will pay, right, or can pay. And so you're effectively a price taker, right? Like these aren't monopoly goods, they're washing machines, right, or something like that. And if the consumer now is comparing models and one is a Samsung that's produced in, say, a factory in South Korea or, wherever. I'm just using one example. And there's one American produced model in the factories in California. Well, now the foreign produced is higher price. American produced can have that competition. They could either try to match it or, steal or increase market share with the American consumer. And so the net effect here with the tariffs is that the playing field has been tilted instead of the way the systems worked for 50 plus years, with everything going on, the dollar, offshore dollars, all of that, where the manufacturing base has the corporation or the business running the manufacturing base has all the incentive to shift production offshore. Now it's the opposite. They tilt it onshore, right? So if you were already producing in America, you're more likely than not going to pick up that new order, which means those cash flows are staying inside of the U.S. economy, its own financial system, which means more employment, more wages. So we just have to wait and see which ones of these effects went out. But it all depends on how does the American consumer hold up? Do they have capacity to spend? So that's what we're really waiting on. Where does the consumer pull back? It's going to impact different sectors kind of uniquely. But this is essentially what the Fed is doing, the wait and see. Like, how does this entire thing net out? But ultimately, like the interest rates, especially on the front end markets, the futures, they're still telling you more rate cuts are coming on the front end, right? And that's what, we have not hit the bottom of this credit cycles. We've only, if there's a checklist on things you want to see, there's only a couple, so far. Hey, you've got the dollar trading at the low end of its range, right? For the, post 2008 uptrend. That's about all. Like, you're still waiting for multiple things before you have a lot of confidence as a portfolio manager that the short-term credit cycle has troughed.
I was gonna say, maybe do you have that checklist? Can you walk through kind of some of those other items that you might want to see before you're trying to say, or thinking maybe we've troughed?
So you're never going to know it explicitly until the unique headline shows up that calls in the fire department to put out the fire. Like, for example, Lehman 2008, right? You're like, oh gosh, they can't let this go any further. Or 2020, like March 2020, when you got the signal, hey, we're going to do $6 trillion in QE, $6 trillion in fiscal, cut rates to zero, go. Like, those headlines are your signal that it's a bottom. Now, there are some cycles where all you have is market signals, like, where is the dollar? Is it bottoming? Whereas, like, for example, 2016, you're looking at oil, right, as the Saudi excess production was trying to work out the shale producers, like basically wash out the U.S. shale industry from the market, and were somewhat successful in doing so. They at least delayed the rise in U.S. shale production for multiple years, right? So sometimes you're looking at commodity prices, sometimes at the dollar, short-term interest rates, do they bottom on the chart? But you won't know, like, it's very hard sometimes to get that, like, instantaneous reaction. You won't know until multiple months, quarters have passed, versus sometimes if it is such an abrupt stop, throw 9/11 into that set of examples. But there's things you're always looking at, like short-term interest rates, dollar, where do the futures markets show, Fed funds or SOFR futures now? Where's the hedging activity showing, where the market believes the behavior is going to go? But sometimes it's also the headline just makes it so crystal clear. It's like, yep, it's over. That was a bottom. They're not going to let it go any further. When I say they, I mean like the Fed, Treasury, et cetera. They're not going to let this credit problem get any worse. So that's kind of what you're looking for. But sometimes it's much more obvious and apparent than others.
Right. I mean, if there's an announcement of some type of major new backstop facility, right? I mean, that's a pretty clear indication that they need to inject liquidity into the market, right? So
yeah, they're not going to let it get any worse. But that's also not a sufficient condition by itself, because the BTFP program in March 2023, right? That was a new liquidity facility introduction, but it was it wasn't the end of it wasn't the bottom of a short-term credit cycle. It wasn't even close. Like we kept hiking before that. And like, as that facility was going out, the common consensus was, hey, this is QE again. Like it's over. They're going to cut. It's like, no, it's not. Like, if you looked at the market signals, like, they're going to hike next month. So sometimes alone, like, a new facility isn't by itself a sufficient condition to mark the bottom of a credit cycle.
It's the magnitudes as well.